Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, and we just did a first video about how we select the properties we recommend to you. What are the parameters for them? And that's what we're going to go into more detail at this point. Now, a good buy in a home is not necessarily a good investment. In other words, if you say, hey, Joe, I got this 20% underneath value, but it takes 90 days to rent, or you get $100, $200, $300 less than anticipated, yeah, it's a good buy. You got it undervalued, but from a point of view of return on investment, it's going to be terrible. Now, I'll give you one example, and this was years ago. We found this house for this client, and it was what's called a short sale, where they were working a deal because they were behind with their lender. And, it's a heck of a deal. It was a great deal, but it was one of those at that time, and this was years ago, took 60 days to rent. And then after the 60 days, the investor said, I don't know about this. But the good news for him was we put it on the market, sold it immediately, and he made a profit. But that was a good buy, but not necessarily a good investment. And so two things that are very, very important to you for a good investment is that, number one, it rents quickly. Does it rent in 5 days? Does it rent in 12 days? 60 days? That's unacceptable to us, because that vacancy is going to lower your return on investment. Maintenance, and this is one of the things we love about new construction, is because it's never been used before. It's also coming with extended warranties on most everything in the home. And so that's mechanical, electrical, plumbing, etc. And so those are important factors for you in terms of making it a good investment. Now, the other thing is that when we look at a home in a neighborhood, we're looking at what is the percentage of investment property in there. If it's 40%, that's really a bad idea. We want owner occupants to be the vast majority. In other words, really 90% should be basically owner occupant. Now, I've seen it, go a little bit higher. It really depends on supply and demand, but that's a good general rule of thumb, is that you want most people who are owner occupants. They're going to drive your investment because you're going to get a return on two things. Number one, it's going to be cash flow. Number two, it's going to be appreciation. And in Oklahoma, especially since this last year, appreciation's gone up about 2 or 3% over normal. And so that compound interest that we talk about, the miracle of compound interest, is also going to drive your investment. So those are very, very important things that we look at. So that appreciation ability of that neighborhood going up is really important. And we look at historical data. We look at every reason in terms of amenities that are going on, jobs, whatever it happens to be, schools, what makes it a good investment in that particular location. And so that has to compute in order for us to really want to go forward. Now, we talked about getting all this information in from the builder and, in the first video, and getting insurance information, what are the rents. So let's kind of go through at this point what the return on investment analysis is, which is a factor of four things. First of all is what's called capitalization rate. And I'm not going to go into detail right now, but cap rate is taking the total investment, not only what you borrowed on it, but also what you put down. In other words, that whole 150, 200, whatever it happens to be. And then your operating expense less your debt service, which is principal and interest. Taxes, insurance are part of operating expense. And we compute a percentage. Now, it's more important in commercial than it is in residential, but it's important to look at it. The second one is cash on cash. So in other words, if you put out $50,000 down payment and closing cost, how much of that are you getting back every year? So we do look at that as an important factor. How is this real money returning back to you? The third thing is what we call equity build. Now, the reason why I say that, if we say that Oklahoma City appreciates 5% per year, that's a macro number. In other words, that's $5,000 to $15 million on a home 100 miles apart. It's macro. It doesn't really tell you about your location. We look at your location specifically. So let's say the market is appreciating at 5, but equity build is 7. That means you've really made a good buy and a good investment. So we localize it specific for the property that you're buying, and that really helps you make a decision. Now, finally is internal rate of return. Now, internal rate of return is you keep your money in that investment for 7 years. What's the percentage return? And this is a way that we can compute versus a stock portfolio, mutual funds, annuities, whatever else that you're investing in. And we want that percentage return. And with a higher appreciation, we're getting about 16 to 20% per year, sometimes a little bit more, but usually about 16 to 20% return on your money every year with a lower risk factor because it's housing. So these are the things that really make it a good investment. This is what's important to us. It's been important to me, everybody else that I know that invest in properties. We want it to be important to you, and we do a lot of due diligence in doing that. So let me see what we're doing next here. Well, hey, prices are up in the last year. We all know that. Is it still a good time to buy an investment property?